I'm Bob Nachman, and I'm a partner with NNP Wealth. Today we're going to kick off our series with some brief comments on the markets and our thoughts. We're certainly in an unprecedented time. The current coronavirus crisis is different than the various other crises the world has been through in the past. However, it is worth noting that all crises are different, and as a result, each one can cause greater concern because we have no historical reference to fall back on. What has changed over the last 2 to 4 weeks is that we've gone from a medical scare to a global shutdown. Therefore, the economic implications have become significantly more serious. It's likely we're either already in a recession or we're headed towards one. In the short run, it will probably be a severe one. And what started out as a market pullback in the market has turned into a substantial decline. At this point, the S&P 500 is down approximately 28% from its recent highs. This is far from record territory, but the swiftness of the decline is record-breaking. So what do we do now? During a typical recession, the market has historically declined 20 to 32%. Therefore, one could argue that the current decline is already pricing in a recession. However, we have had numerous times in history when the market has fallen further. 2 of those were in the last decade. Historically, these have been during deep and lasting economic declines, such as the Depression or the Great Recession. The question now is how quickly can we contain the virus and begin to flatten the spread, as well as what the federal government can do to stop the economic bleeding. If we're successful on this front, in a reasonable period of time, we believe we're nearing a point where the vast majority of the market risk is behind us. In fact, we would slowly begin to add to equities for long-term investors. And while you wait for a recovery, the dividend yield on high-quality equities is significantly higher than you'll receive for cash or bond instruments. It's important to remember that the stock market is a leading indicator and therefore already is assuming a weak economic environment is on the way. It goes down in advance, and in fact, the market return during a recession is historically positive. It's also going to begin to climb at some point during the recession, not waiting until it's over. For our clients, events like these validate the importance of proper financial planning. Our planning assumes both good and bad market outcomes and helps to determine the appropriate level of risk for each specific situation. The process has served us well through numerous crises, and as mentioned before, 2 of those were significantly worse than the current decline. Personally, I've been in this business now for 34 years. I have seen firsthand the crash of 1987, the recession of 1990, the Latin American debt crisis, the tech bubble burst of 2000, 9/11, the Great Recession, and now this. And believe me, I can promise you they don't get any easier with time. Each time has its own set of concerns, and each time you wonder, how bad is this going to get? Unfortunately, no one can know how the situation will pan out, not even the experts on CNBC. However, we have always come through, and we believe this will be the case once again. Please let us know if you'd like to talk further, or feel free to submit your questions.